Good morning, everybody, and welcome to our HUBsights webinar. I'm Anne McDonald, the Head of Marketing here at Hub24. During the month of October, we've been showcasing all the great insurance options available on our platform. And today we're delighted to be joined by Scott Hoger, Technical Account Manager from TAL, who'll be taking us through some super insurance strategies. Just before we start, I just need to mention a few housekeeping items. The lines will remain muted throughout this presentation to prevent any background noise. So if you have any questions, please use the webinar control panel to send them through to the team. We will hold a Q&A at the end of the session. Great, now that's out of the way, I will hand over to Scott to begin his presentation. Thanks, Scott.
Good morning, everybody, and thank you for joining us today at this technical session provided by Hub24 and TAL. Today's session is going to be super insurance strategies, and I think it's going to be a really good session to get our heads around some of the big changes in legislation over the past few years and how we might be able to use that legislation change to our advantage when we're having our conversations with clients around risk cover. So I suppose to start off, why are we here? Well, we're here because there's a growing trend towards insurance and superannuation, and on the next slide I'm going to run through a few statistics about the sorts of levels of cover we're seeing via this environment. And we know the 2016-17 federal budget resulted in some of the biggest changes in super since the simplified super system in 2007. Now, I think most of you who are on the line today would agree that superannuation certainly isn't simple, and over the last few years it's become more difficult for clients and advisors to comprehend. These changes over the past few years have seen widespread comprehensive changes that will mean that we need to ensure we start to adapt to the new world and provide advice that makes sense for our clients in this space. So in terms of why we're here, actuarial consulting firm Rice Warner estimates that 71% of all life cover, 88% of all TPD, and unbelievably 59% of all income protection cover is provided through super. Now that is quite overwhelming in terms of the statistics, because in 2012 those numbers were far less, certainly before retail risk was offered by the superannuation system. I think the big one to focus on here is the 59% of all income protection cover is written by super. That trend has been substantial over the past 5 years. In 2012, as mentioned before, that was around the 20% of all cover, and now we're up to sort of 60. At TAL, our retail risk levels in terms of IP and superannuation is around the 70%. So when we're using this sort of cover via superannuation, we need to understand what the implications are and what that means for our clients in terms of their products. A recent discussion paper from the Insurance and Superannuation Working Group spoke about the fact that despite we've got all this cover in superannuation, insurance at an individual level may be insufficient to meet the needs of members or their beneficiaries. And I think that's a really important point, because we have a lot of group cover in place. We've got a lot of younger Australians holding group cover within their superannuation funds, but these young clients may not need the types of coverages that we offer via the group space, and certainly this is where financial advisors come in to provide that tailored specific advice, because we know as a client gets older, their needs are likely to increase. So all those clients who are middle-aged, with mortgages, with kids, with debt, all that sort of stuff, they've still got those same group policies they held when they were younger, and they might not be sufficient to meet the needs of their members or beneficiaries. 15 years ago, $500,000 was a lot of life cover. In today's world, $500,000 is not a great deal if you look at the average mortgage in places like Sydney or Melbourne. And the regulator has already stated that they intend to focus on insurance advice through superannuation. This is a really important one. In February this year, the regulator came out and spoke about the fact that they're noticing cover written via super, and they want to make sure that the client's needs and objectives are met when cover is written via this environment. And one of the things they did speak about back then was things like erosion. So what does the erosion mean on the balances of the client's superannuation? And secondly, what about things like cash flow? So if you're going to recommend insurance and superannuation for cash flow purposes, has that cash flow been detailed? Is that cash flow known within the fact find document? And it's really important to consider the reasons why we might recommend cover outside of things like cash flow, because insurance and super can provide our clients with really substantial benefits, which are in addition to things like cash flow benefits. And we'll cover those obviously today. So in terms of some of the things we want to cover today, we want to firstly look at concessional contributions. So we know that concessional contributions have reduced from $30,000 and $35,000 down to $25,000 from the 2017 financial year. Now, importantly for our clients, we're going to need to determine how we use this new concessional cap for both insurance policies and also our clients' retirement savings objectives. If we are going to exceed the concessional cap, then the calculation of any excess concessional contribution above this cap will be treated in the same way as it is today. So what are the insurance implications to this change? Well, firstly, clients using contributions to fund insurance premiums will have to balance their retirement savings objectives against the lower cap. So clients that actually use their concessional cap to fund an insurance premium will need to balance this. Now, most clients in today's world do not fund via contribution. Most clients in today's world fund via accumulated savings, whether it be via the fund itself or via the rollover process. But you've got some clients who are actually making contributions to fund an insurance premium, because the important thing to remember in relation to concessional contributions is that the government doesn't distinguish the difference between a contribution for superannuation savings and a contribution for insurance premiums. So both of those are going to count towards your concessional cap, and we're going to need to balance this against the client's retirement savings objectives. Clients and their advisors will need to understand what portion of the cap has been taken up before any contribution funded insurance strategy is put in place. So we have to consider what actually makes a concessional contribution. So let's think about this now. Firstly, you've got your clients' SG contributions going in. You've got clients who are employees who are receiving, for example, bonuses. Part of that bonus may go into superannuation from the employer, and that will also count to your client's concessional cap. A lot of your clients are going to have insurance policies in super which are offered by their employer. Now, the reason that the employers offer this insurance and superannuation option is because when they do it this way, the premium for the policy is effectively a contribution, which will count towards your concessional cap. But also, they don't have to pay things like FBT if the group scheme was held outside of superannuation. So that's also going to be included in the concessional cap. And of course, any personal deductible contributions are also going to count to your cap if the right forms are filled out, and we'll go through those forms a little bit later in today's session. You might want to still make an excess concessional contribution to fund an insurance premium. So actually exceeding the concessional cap may still be beneficial for clients if they are going to pay for an insurance premium through superannuation, because we know that premiums outside of superannuation are very tax inefficient. And the one thing I know about clients is that they love to have tax deductions. So we'll talk about what that looks like on the next slide. So the excess concessional contributions tax is actually calculated using the client's marginal tax rate, less the 15% contributions tax, and that's what the client's already paid on that concessional contribution. So a client on the highest marginal tax rate, therefore, would have a 32% tax liability on the excess contribution. So take that 47 cents in the dollar highest marginal tax rate amount minus the 15%, which is the contributions tax, totals a 32% tax liability within the fund. Now, remember that from an excess contribution perspective, the tax can be paid by the super fund or the individual taxpayer. But in this strategy, what we want to do is we want the individual to pay for this excess themselves, because we're trying to balance this insurance need, this tax saving, against the client's retirement savings objectives. If you do exceed the cap, though, you're going to be levied an interest charge at 9.75%, and that interest charge is levied at the start of the tax year. And the reason that they charge you at the start of the tax year is so you don't just exceed the cap on the final day, June 30 of the tax year, and only have one 365th tax liability. So if you're going to exceed the cap, doesn't matter when you exceed it, interest will be charged from the commencement of that tax year. And exceeding the cap to fund the premium may be desirable because, if you think about it this way, the contributions tax the client pays on the way in, the 15%, is actually going to be offset by the corresponding tax deduction the trustee claims for that insurance premium. So in the case of HUB24 trustee, they're going to be able to claim a tax deduction for the premium on the insurance policy the client takes out, which means they're going to have this effective tax arbitrage where this insurance deduction is going to offset contributions tax. So the way it might work in terms of an example is you've got John, who's a medical administrator. aged 50, highest marginal tax rate of 47%, needs $1 million of life cover, and that premium is going to be $15,671. Now, John's already making concessional contributions up to his cap. So we've got two options when we consider how we're going to fund this premium. The first is, well, do we fund it outside of super? And as I mentioned before, funding outside of super can be very tax inefficient because the benefit is capital in nature and therefore not tax deductible. Or we have the policy funded inside of superannuation and John makes a concessional contribution in excess of the cap. So what does that look like in terms of calculation? If you can look on the left-hand side of the screen, you've got the various components of this calculation. In the middle, you've got the non-super calculation. Now, the non-super calculation is pretty straightforward. What is it going to cost John to fund the $15,671 in premium? Well, John's going to have to earn $29,658 because he's going to pay $13,897 in income tax. Now, that requires John in total, obviously, to earn $29,678 in terms of his total amount to pay this premium. If he does it via super, has his employer make an additional contribution of $15,671, he's obviously going to do this before tax. He's going to have to pay contributions tax of $2,350, and that is going to be offset by the corresponding tax deduction the fund is going to claim for that premium. He's going to need to earn $9,462 to pay this excess contributions tax of $5,015. And if you recall, that's going to be that 32% liability. And of course, he's going to have to pay interest of $733, which is going to be added to the total cost of this cover. Now, funding it via super in this example comes out at $25,866, which puts John in a better position by about $3,700. That's a really good result, despite the fact he's exceeded his cap. And that's only been able to be given to John because of the fact that the fund is going to claim a deduction for the premium inside of superannuation. So let's think about what the implications are for this particular strategy. So firstly, exceeding the concessional cap may be beneficial for clients in certain circumstances. So the client is going to have to be in a situation where they've already utilised their full concessional cap. And there's other factors we're going to need to be aware of as well, as we'll see on the rest of the slide. Care must be taken in presenting this strategy to clients, as it will result in an excess tax determination. Now, I know in my experience as an advisor, when clients tend to get ATO letters, they think it's going to be a refund in most cases. So obviously, when we're using this particular structure, we're not going to get a refund, we're actually going to get a tax liability. And that's going to be some time after the end of the tax year. It would be prudent for clients to seek independent tax advice. And that makes sense in general terms anyway, because any sort of tax-heavy strategies should really be looked over by the client's accountant. And the strategy has got to be balanced against any other tax strategies they have in place with the accountant, because sometimes, not all the time, but sometimes an accountant will act independently of the financial advisor. They may have two competing strategies. It's important that everybody is aware of what's on the page to ensure that both strategies are going to work for this particular client. Any concessional contribution in excess of the concessional cap is counted towards the client's non-concessional. So the new rules around what you can put in a superannuation on a non-concessional basis is going to have an impact on whether you can use this strategy or not, because obviously clients with more than $1.6 million inside of superannuation, inside the superannuation account balance, are going to be unable to use this strategy because you cannot make any more non-concessional contributions when a client's got a balance of $1.6 million. So this strategy is going to be limited in its application, but can be very beneficial for clients in the right circumstances. Okay, so the big one that I think came through the 2016 budget update was this whole conversation around deducting personal contributions. Now, this is a really important one for insurance. It's an important one for clients in accumulation work as well, but from an insurance perspective, I think this was missed in terms of all the advertising and all the news surrounding the budget changes. So the big point here is that last year's tax year required clients to earn less than 10% of their income from employment activities to claim a deduction for personal contributions to super. So that was called the substantially self-employed rule, or the 10% rule, and the majority of our clients, to be fair, didn't meet this criteria, and weren't able to claim deductions for contributions to superannuation, what they would have to do is salary sacrifice. And that was a little bit unfair for those clients who are employees because not all employers offered the salary sacrifice option. So what the government did from the 2017 tax year was to level the playing field in terms of who now can claim a tax deduction for contributions to super. So that now means that anyone under the age of 65 is going to be able to make a contribution to superannuation within their concessional cap and claim a tax deduction, which is fantastic news. So what are the insurance implications to this one change that the government provided us in terms of deductibility? So firstly, if we think back to prior to July 1, the only clients that really used this strategy, so clients that held superannuation fund policies and paid a contribution, were self-employed clients. Because what we were doing there for that particular strategy is we were effectively giving the clients a tax-deductible life insurance premium. And that was obviously only for self-employed clients. But obviously from July 1, this strategy is now available to employees also, allowing a tax deduction for authorised insurance benefits, so your life, your TPD and your income protection cover. So clients who have been funding their benefits via accumulated balance may now be able to offset this erosion by simply making a personal deductible contribution equal to the premium and claiming a tax deduction for it. And that's great news for clients because we're now able to level the playing field and effectively give the clients a tax deductible life insurance premium. And I think one of the things that many clients were searching for in respect to life cover was tax deductibility. And ultimately, in most cases, they weren't eligible for it. This new one change allows us to effectively get tax deductible cover. And for those clients already salary sacrificing, for those clients who have already gone to their employer and put a plan of attack in place for salary sacrifice, they can either continue along that path or they can simply cease salary sacrifice and wait till the end of the financial year to see exactly what they've got from a cash flow and budgeting perspective, from a savings perspective, to determine how much they're going to be able to take advantage of this one rule change. And we certainly don't suggest stop salary sacrifice. What we're suggesting here is for risk clients who've now got the ability to go back to them every year in June to determine whether they've got the ability to make a tax deductible contribution into the fund in order to get them effectively a tax effective and efficient benefit. In terms of the other implications we need to be aware of, this one change will allow financial advisors to probably get more involved with the client's accounting referrers who are not licensed to provide advice. So recall a couple of years ago now, the accounting exemption was removed, which meant that accountants who wanted to provide personal advice needed to have a license to do so. So an example might be an accountant can tell you to take advantage of this new rule change, to take advantage of personal deductible contributions. But unless they were licensed, they couldn't tell the client how much to put in. And that's where financial advisors come in, because they've got the license, they've got the ability to provide personal advice, and they can now provide their accountants with an additional service around things like funding for insurance premiums. Obviously, as you'll be discussing this sort of information around tax time, we can assist with the advice component of any contribution the client makes. And of course, when they do that, what a great opportunity there is to review the client's other financial needs in terms of insurance and superannuation. The important thing to remember from this change is that generally speaking, contributions to superannuation are going to be classified as non-concessional unless you comply with the relevant notice formalities. And the relevant notice formalities are going to be this section 290.170, which is also called a notice of intent. And what that is telling the fund trustee that the client intends to claim a tax deduction for the contribution that's gone in. So for example, I could put a $10,000 contribution into superannuation, and the way it would be treated by the super fund is that it would be non-concessional. And unless I fill out this 290.170 form, the fund will always treat it as non-concessional and I won't get a tax deduction. So what I need to do is get the 290.170 completed, and we need to get it completed, obviously, to get this tax deduction. There are a couple of things you need to be aware of on the 290.170. It must be completed when the client is a member of the fund. The money needs to be in the fund, and the fund itself needs to provide acknowledgement back to the member that they've got the form and they're going to treat it as a concessional contribution. So there's a few things you need to be aware of in relation to this, but getting to 291.70 is a really important one. One of the other changes that they made in the 2016 budget update was this unused concessional carry forward. So whilst on one hand they've limited the ability for financial advisors to utilise the higher concessional contribution caps, they are introducing to certain clients this unused concessional carry forward. So the whole idea around this is for clients who are going to be able to carry forward their unused concessional contributions and make them in future years over a 5-year rolling period. Now, why is this going to be good? Well, because obviously it's going to allow clients to make tax-deductible contributions above their concessional cap for the balances that they've unused. So if we use a simple example, a client earning $150,000 income, if we round out their SG contribution at $15,000, that means they've got $10,000 to use up to their cap, which they could use for this unused concessional carry forward. The way it's going to impact financial advisors is obviously for clients who are self-employed or have irregular income patterns, they'll be able to catch up their unused portion of the cap, and that's really good news because getting more money into super is going to be really important for clients, obviously, as they start to get close to retirement. It's only for balances under $500,000, and one of the great things you can use this unused carry forward benefit for is to say ensure that the client's superannuation is not eroded over a long period of time due to superannuation insurance premiums. So the regulator or the tax office gave us a couple of really good things that we can use to mitigate erosion of superannuation balances. So the first one obviously was the personal deductible contributions. Allow a client to make a personal deductible contribution, and that will obviously offset the erosion. Or if it's been over a longer period of time where they can't use that personal deductible contribution, they might be able to use this unused concessional cap and make a more bulkier contribution to the fund. We know how clients are probably going to use this particular measure, and they're probably going to use it to offset things like CGT when they sell an asset. But either way, you can still use it for that, you can use it for insurance, and it's a great way to get more money into superannuation. The transfer balance cap, this is probably one of the big things that obviously came in July 1. It's sort of like the old RBL, and it obviously is going to limit the amount of money a client can have in tax-exempt pension phase to $1.6 million per member. So amounts in excess of that must remain in the accumulation phase or removed from the superannuation system. So obviously prior to July 1, you would have needed to reduce your pension balances to 1.6 and transfer the excess into accumulation or remove from the superannuation system altogether. One of the big questions we got at TAL in respect to insurance on the transfer balance cap is, does having an insurance policy inside of superannuation with more than $1.6 million offend the transfer balance cap? And the answer is no. Having an insurance policy in excess of the 1.6 within super does not breach the cap, because we're talking about retirement savings, or sorry, pension phase money only. So the transfer balance cap is not going to limit the amount of cover you have in super, but it will impact the way the client intends to distribute the claims proceeds. And there's going to be more of a focus on this in the future around how do we get an insurance benefit out to the members' beneficiaries in an efficient and effective way. And that's going to be really important to understand moving forward, because in most cases, insurance policies are paid in lump sum form. And lump sum form might be great, but it might not be the best way for a beneficiary to receive the money. For example, my personal scenario, let's just say I've got an insurance policy of $1.6 million, and the reason I've got the insurance policy is I've got $500,000 in debt, I've got a $900,000 income requirement, that's to provide my spouse in the event I'm not around, and a $200,000 education fund for my child. Now, there's three distinct purposes in that recommendation, or sum insured, with three distinctly different needs. So the capital amount, the money I want to pay out in capital, which is the debt, I want my wife to receive to be able to pay off the lender. The $900,000 I'd love to have paid via a pension, because pensions can give you really, really good benefits. And the $200,000 I might pay it out as capital and have it funded via an insurance bond, or I might simply do something like having a child pension within the fund. there are many different ways to be able to pay out a death benefit, and the transfer balance cap is going to play a part about what you can receive in pension phase. Any benefit paid in lump sum form that leaves the superannuation system will not affect the transfer balance cap. But when we are paying in pension, as per my example before, that's when we're going to have a different impact for the beneficiaries. Unfortunately, the impact is different depending on who the beneficiary is and whether the deceased or the beneficiary had a transfer balance cap when they passed away. So it's really important that we consider the distribution of these claims proceeds, because if we think about things like pensions, the value of the asset supporting the death benefit pension to tax dependents, for example, my spouse, will obviously have that value assessed against their transfer balance cap. The important part to remember here is that the pension recipient or the spouse does not get access to my or the deceased member's transfer balance cap. They're going to have to use their own. If they haven't got one today, for example, my wife doesn't, she's going to inherit the $1.6 million. In terms of that value will effectively start the transfer balance cap for that beneficiary. And remember, the way that the transfer balance cap works is that it's proportionate. So if I leave my spouse $1.6 million in pension phase, she will have used $1.6 million of $1.6 million, which means she's used the cap 100%. Which means when the cap does increase moving forward, let's say it goes to $3 million, my wife is not going to be able to simply put in an additional 1.4 from her accumulation account. She's used the account 1.6 of 1.6, therefore she's used it 100%. She's not going to be able to tip any more money into superannuation. So it's a really important consideration about the transfer balance cap. The other things to consider about the transfer balance cap pension phase is that, remember, even if my spouse is, say, early 30s, she's still eligible to receive a death benefit pension. And the important part about that to remember is she's effectively going to be able to get around $49,000 a year tax-free in the absence of other income by taking advantage of things like the 15% rebate and, of course, the low income offset. So it's a really good strategy to give access to really tax-efficient income to spouse beneficiaries. Other federal budget bits and pieces that are worth bringing up in today's forum. The first one is anti-detriment benefits were abolished from July 1, 2017. So that's the first one. The transfer balance cap also applies to TPD pensions. Now this is a really interesting one because there's a really big conversation going around at the moment around how do we deal with taxation in respect to TPD benefits through super. So we know if the client's under the age of 60, they're going to have to deal with tax in one way, shape or form. If they're under 55, the tax liability is going to be higher. So it's really important to understand how we deal with this particular tax liability. So if you think back to your SOA, what we put in our SOA in terms of recommendation is we have a total amount of insurance required, which is after tax. And yet most of the recommendations we might put through super is going to have a tax liability at the end of the day. So how do we deal with that tax liability? We could gross up the cover, but when we gross up the cover, we're going to need to know things like the eligible service period, the date of retirement, and of course, we're not going to be able to work it out, but the date of event. So that's harder to do. We might simply put it in the SOA that there's a generic warning saying you're going to pay tax. Well, thirdly, you might consider the use of things like TPD pensions. And TPD pensions effectively allow the insurer to pay the benefit to the trustee of the fund, and the trustee releases the benefit as a pension, not in capital. And when you release it as a pension, you still get things like the 15% rebate. So what you could theoretically do is have a pension paid from your TPD balance with access to the 15% rebate, and have a complementary income protection policy running alongside it, paying an additional benefit, your 75% of your income, to complement the money you're pulling out of superannuation via the pension. Now, this is obviously going to give you more than 100% of your earnings, but the difference in this is going to be is that in relation to the IP benefit, we're not going to offset any benefit coming from your superannuation fund. So it's a really good solution, not obviously going to be able to be used for everybody, because most of the time we see when clients get big TPD benefits inside of the superannuation policy, they're like to pull it out and pay off debt and do all the other things that they might want to do with it. So it's used in limited circumstances, but certainly could provide your clients with benefits. Remember, if you are going to use this, the transfer balance cap also applies to TPD pensions, meaning that you're capped at the $1.6 million. The work test, which was one of those things that I think everybody wanted to have removed, unfortunately is still going to apply for those aged between 65 and 75, with that requirement of 40 hours employment in a 30-day period. Now, we know that the current government wanted to abolish the work test, but it was blocked by the Greens and Labor. This is something that may come up in the future in terms of a change they might make over the next little period of time. It didn't get changed in last year's budget, obviously, but hopefully in the future we're going to see this work test removed to allow more clients to make contributions to superannuation in a more simplistic fashion. And lastly, one of the things that got unnoticed, I think, from July 1 was this change in rules around rolling over a death benefit. Now, in the past, Fund A couldn't roll over a death benefit to Fund B. So when it was rolled over, it lost its sort of status as a death benefit, which made it very difficult for the receiving fund to deal with. So effectively what had happened in the past is that if you wanted to roll over a death benefit, most trustees would simply turn around and say no. From July 1, however, there's been a change which now allows superannuation funds to roll over death benefits from Fund A to Fund B. And a reason you might want to do that, for example, is to pay a death benefit pension. Now, we've sort of gone over a little bit about what death benefit pensions can do for your clients. So there may be a real need or want to do that. So if you do need to roll over a death benefit, you can certainly do it from July 1. A couple of other things that come as part of this is that obviously when you do roll from Fund A to Fund B, the death benefit itself is going to retain its status as a death benefit, meaning that wherever it's rolled, it's going to be a death benefit, which means that if the client no longer, or the beneficiary no longer wants to receive the benefit as a pension, they can't simply put it back to accumulation. They're going to have to pull it out of the system. So if you roll from Fund A to Fund B, you can't put it to your accumulation. It's a death benefit, and death benefits have to be cashed, meaning that you're going to have to either take the pension or pull it out of superannuation altogether. If you do pull it out of superannuation altogether, you're going to have to deal with the existing caps that we spoke about before in terms of putting money back. Okay, so I think we're over to any questions from the attendees in respect to what we've spoken about so far.
Yeah, thank you very much, Scott. There were some really great strategies in that presentation. So we have had a couple of questions come through to us. The first one, if the client pays an insurance premium using a personal deductible contribution, does HUB24 as the trustee of the fund also get a deduction for the premium?
So that's a really good question, because obviously we're looking for tax efficiency in terms of how the client pays the premium. So if your client makes a contribution into HUB24, so let's say it's $5,000, and they're within their concessional cap, as long as they fill out their 291.70, they'll get their own personal tax deduction against their income tax. The fund itself receives the $5,000. Now that's good news, and normally what will happen is that HUB24 will withhold 15% for contributions tax, but HUB24 will also be able to claim a tax deduction for that contribution or premium paid to the insurance policy. And what that deduction is going to effectively do is offset that contributions tax. So not only does the individual taxpayer get a deduction, but the trustee of the fund also gets that tax deduction. So it's really good news for both parties.
Fantastic, everyone's a winner. All right, and another one here, can you pay a death benefit from superannuation to an adult child, or do they need to be below the age of 18? Okay,
so this one comes up fairly regularly at TAL as part of our tech service. The important thing to remember about children beneficiaries is that a child is always going to be a CIS beneficiary, and that's really good news. So it doesn't matter how old that child is, they're always going to be a CIS beneficiary for the purposes of paying out a death benefit. So that means that your clients can nominate their adult children as beneficiaries, but if they are adult beneficiaries, there's a tax that they're going to have to pay, which is on a formula basis. So if your client meets the CIS beneficiary definition, which is obviously a child, but does not meet the tax beneficiary definition, which is typically for a child, it's under the age of 18, then you're going to have a tax levy, but it certainly doesn't stop you from paying that benefit through to that child.
Perfect. Thank you. So that is the end of the questions for today. So we'll wrap up. Thanks again, Scott, for joining us. And thank you to everybody who dialed in. If you'd like to get in contact with TAL or know more about their offer on HUB24, then please get in touch with your BDM. Thanks, everyone.